Okay, stop what you are doing right now. Literally, if you've been focusing purely on AI software or, semiconductor stocks, you might be completely missing the absolute most critical infrastructure play of this entire decade. Today, we're diving deep into a niche clean energy tech company that basically just became the beating heart of the global AI buildout. By the end of this explainer, you're going to see exactly why tech giants are literally abandoning the traditional power grid and whether Bloom Energy's explosive Q1 2026 earnings are just a blip or the beginning of a massive permanent structural shift in how data centers actually operate.
I mean, just look at this number, 130%. That is Bloom Energy's explosive revenue growth in just the first quarter of 2026 alone, hitting a staggering $751.1 million. They didn't just casually beat Wall Street's consensus expectations of $552 million, they absolutely obliterated them. This is a monumental milestone. It actually marks the very first time in their entire history as a public company that they've delivered triple-digit year-over-year revenue growth.
But, numbers of that magnitude, they don't just magically materialize out of thin air, right? To really grasp these shocking financials, we have to stop and ask ourselves, how on earth did a fuel cell company transition from building standard commercial microgrids, like we're talking providing backup power for local grocery stores, to suddenly cowering the biggest artificial intelligence data centers in the world almost overnight? Like, what actually shifted in the macroeconomic environment to trigger this kind of crazy hypergrowth?
Well, it all comes down to the AI power bottleneck. We have officially entered an era where electricity itself is the ultimate limiting factor for artificial intelligence. Think of it this way. The traditional power grid is effectively a massive, miles-long traffic jam. Building new transmission lines and securing grid connections, that takes years of waiting and endless red tape. Hyperscalers and cloud providers simply cannot afford to sit in that traffic. They are in a fierce arms race, and that is time they absolutely do not have.
So, what's the fix? It actually lies in Bloom's completely off-grid technology, the solid oxide fuel cell, or SOFC for short. Now, this tech actually has its roots in NASA research, and it generates clean, incredibly reliable electricity directly from fuels like natural gas, biogas, or hydrogen. And it does this using an electrochemical process, meaning there is absolutely no combustion involved, zero burning. It just delivers high-density, low-emission power right on site, essentially dropping the energy source directly where the massive compute power is needed.
And guys, the timeline difference here is just staggering. While relying on the traditional power grid means waiting years and battling severe capacity limits, Bloom's island and microgrids completely bypass the grid altogether. They can deploy 100 megawatts of power behind the meter in just 90 days. 90 days! For an AI firm trying to stand up a massive new compute cluster, that kind of speed to market isn't just a nice little perk, it is quite literally the ultimate competitive advantage.
And honestly, the broader market is validating this speed-to-power strategy at a scale we've barely seen before. Just look at the sheer velocity of these contracts. It started with a 1 gigawatt framework with American Electric Power back in late 2024, then moved to a dedicated deployment for AI cloud provider CoreWeave early in 2025. That was followed by a monumental $5 billion deployment financing deal with Brookfield in late 2025. This rapid succession of multi-billion-dollar deals firmly solidifies Bloom as the absolute go-to rapid deployment standard for hyperscalers. Now, the Oracle mega partnership from April 2026, that takes this whole thing to an entirely new level. Oracle didn't just sign a standard contract. They initiated a complete paradigm shift. They pivoted to a 100% Bloom solution for up to 2.8 gigawatts of power. They are actively scrapping their previously planned gas turbines and diesel backup generators just to stand up these clean AI factories. With an initial 1.2 gigawatts already contracted and deploying right now, they are literally creating one of the world's largest islanded microgrids. And then, literally just weeks later in May, the Nebius Group dropped their own massive news, a partnership worth up to $2.6 billion. This really proves that Oracle wasn't just some isolated win. It's part of a massive, undeniable trend to secure energy supply for full-stack AI clouds. With 328 megawatts of installed capacity planned to be fully operational this year alone, the Nebius deal entirely eliminates the need for reciprocating combustion engines at their site. It serves as definitive, rock-solid proof of Bloom's fast time to power for extreme compute workloads. So, as you can probably guess, these massive hyperscaler mega partnerships are the direct catalyst for this crazy financial climax. Total revenue surged from $326 million in Q1 2025 to that huge $751.1 million figure in Q1 2026. If you dig into the SEC filings, product revenue specifically skyrocketed over 208% year over year. Why? Because these massive data center equipment deliveries finally began officially hitting the balance sheet. But wait, because the bottom line is where this story actually gets even crazier. 340%. That's the huge earnings beat Bloom posted for Q1. They delivered 44 cents in non-GAAP diluted earnings per share, which completely shattered analysts' expectations of just 10 cents. And on top of generating over $73 million in positive operating cash flow, they saw their non-GAAP gross margins expand to 31.5%. So they aren't just, pushing more units out the door. They are unlocking some tremendous operating leverage. Because of this massive structural shift in demand, management went ahead and aggressively raised their 2026 full-year outlook. They're now targeting roughly 80% revenue growth at the midpoint, landing somewhere between $3.4 and $3.8 billion. They also bumped up their non-GAAP operating income guidance to between $600 and $750 million. JP Morgan analysts actually noted that this massive guidance raise was, quote, not a typo, but a clear reflection of a business that is scaling rapidly while simultaneously expanding its margins.
Now, let's talk about the elephant in the room. Because, the biggest fear for any retail investor looking at a hyper-growth infrastructure stock is the threat of massive shareholder dilution just to pay for manufacturing expansion. Well, Bloom attacked this fear head-on. To fuel all this growth without totally destroying their balance sheet, they executed a major capital strategy pivot by securing massive third-party project financing, anchored by that $5 billion Brookfield partnership we talked about, plus a $2.5 billion zero-coupon convertible notes issuance. They are now fully funded to double their manufacturing capacity to 2 gigawatts by the end of the year. And the best part, they're doing it without diluting the stock to oblivion.
And when we actually analyze their competitive edge, well, Bloom is honestly leaving its peers completely in the dust. They are outpacing their closest clean energy competitor, Plug Power, by a staggering 5-to-1 revenue margin, bringing in $751 million compared to Plug's $140 million in Q1 2026. And according to forward consensus estimates, this absolute dollar gap is only projected to widen significantly through the rest of the year. We are absolutely witnessing a true market inflection point here. Bloom's founder and CEO K.R. Sridhar actually summed it up perfectly on the latest earnings call. He stated, "Where Oracle is going is where the broader market is headed." Bloom is rapidly shedding its old identity as just another alternative energy firm and is firmly cementing itself as the absolute standard for on-site primary digital power in the AI age. Looking at the future outlook, the financial models suggest that even though the stock is already up over 225% year-to-date, this really might just be the opening act. Right after the earnings print, Wall Street firms like Mizuho, Morgan Stanley, and RBC immediately upgraded their price targets well past the $300 mark. But if you dive into the deeper fundamental valuation, the ticker mid-case model projects a massive target of $842 by December 2030. And that's assuming a pretty conservative 25% revenue compound annual growth rate. That implies an estimated 208% total return from current trading levels. So here's the biggest takeaway I want to leave you with today. As this AI arms race just continues to accelerate, is relying on the traditional power grid slowly becoming the single biggest liability in all of tech. If this incredible hyperscaler contract velocity continues to outpace actual utility upgrades, we might literally be watching the beginning of a massive corporate decoupling from the grid altogether. Thank you so much for joining me on this explainer, and we will definitely see you next time as we continue breaking down the crucial systems powering our world.